To talk about how to keep your interest rate low in 2023 when you're refinancing your mortgage. Really key information that I would like to share with you today, because when you're refinancing your mortgage, the last thing you want to do when you're consolidating all your credit cards and taking some money out for your home renovations is to really spike your mortgage payment. And I'm going to be sharing some data and some numbers that I've put together here today on my podcast. I'm going to be sharing this live here on LinkedIn, Facebook, Twitter, and YouTube. If you're watching on Instagram or if you're watching on TikTok, you won't be able to see this information the same way, but I'll talk it through with you all just to make sure that we can communicate this all to you very effectively. But essentially, there is a strategy that I'm using these days to be able to keep my clients' interest rate low when they're refinancing their mortgage. And it's a great strategy. It allows them to access some of their home equity and their interest rate that they have fixed already on their mortgage. I don't change that at all. It actually remains in place, and you're accessing that new money at and not really changing your payment very much. So let me bring up this information here. I'm going to share it with you all today. If you're watching on YouTube or Facebook or LinkedIn, you'll be able to see this information right away here. Let me just bring it up here. Okay, let me see if I can show it in a way that, that's not really going to work. Let me try to restructure it here for you all. I was trying to design it so we could look at it together here, but it's not looking right here. So let me reorient it here. Okay. So there we go. That's looking much better. Okay. If I can just zoom in on that. Okay, if you can see that there, you can see right away that we're looking at an example today of someone, say if it's yourself or just a random individual, they have a $350,000 current mortgage, right? And they locked this mortgage in back before COVID. Actually, during COVID, when rates were really low, when COVID was happening, and they locked in at 2.19%. Fantastic rate. I wish I could get a 2.19% rate today. Wouldn't that be amazing, everyone? Like, just to be able to lock in at 2.19%. So we're looking at taking out $100,000, but right now the mortgage payment is $611.43. Let me see my file. It's just a little bit in need of straightening there, and it's bugging me. So let's fix that. Okay. So the current biweekly payment we're looking at is $611.43, right? So when we take that biweekly payment for that $350,000 locked in at 2.19%, if we're looking at taking out $100,000, some mortgage companies, when you approach them, they'll actually say to you, you know what, we can do that for you, but you're going to have to give up your 2.19% interest rate, and you're going to need to take out a interest rate at 6.29% currently. And that is too high of an interest rate. It is much too high of an interest rate. And I don't want to put my clients in that interest rate, because essentially that will take your current biweekly payment from $611 and more than double it. It'll put it at $1,271.51. So $1,271.51 biweekly for you to refinance that mortgage, taking out only $100,000, but current interest rates, right? So 6.29%, such a huge amount. And you might need to access this equity to pay off your credit cards. You may need to access your equity to do some home upgrades. You may need to access your home equity to replenish your emergency fund. And those are very valid reasons to be able to refinance your home today in 2023. And the idea of going from a $611 biweekly payment to a $1,271 biweekly payment just to refinance and increase your mortgage from $350,000 to $450,000 doesn't really make sense. So what I am doing with my clients is a little bit of a different strategy, and essentially we are able to take their existing locked in mortgage and blend it with the new mortgage. We essentially keep that interest rate locked in for the money that you have locked in already at the 2.19%. So that would be the $350,000 that is locked in at 2.19%, right? And then we add on that new 100,000 only at the 6.29%. And when we blend those two interest rates, right? We essentially take the biweekly payment for your 350 and add the biweekly payment for the 100,000 at 6.29%, and we get a new biweekly payment of $884.14. So that is a much better calculated payment than looking at it when you're looking at taking out 100,000 and taking it at current interest rates. So I strongly recommend the blend option. So if you followed with me so far, if you have any questions, type them in the chat, whether you're watching on Instagram, TikTok, LinkedIn, Twitter, Facebook, YouTube. I want to be able to get these questions answered. And if you need help, I'm here. You can send me a private message as well. I'm in the business now for 13 years. I've seen some crazy stuff happen in the mortgage industry, and this is one of the craziest times I'm seeing. People are coming up to their renewals and they're having situations where they need to get part-time jobs just to be able to keep their home, and they need to cut back expenses for normal things that were in their budget just to be able to keep their home. And it's quite crazy because everyone was used to living in a world where interest rates were 1% and 2%. It was really no work to be able to access additional money. You just had to show that you had a decent income and you could access that money. Now, if you've accessed that money in the past, now you need to repay it back. And to repay it back, interest rates are just so much higher. And they're at a point now where I don't know if anyone watched the Jerome Powell speech yesterday when the Fed announced that they were holding interest rates where they are at today and did not choose to increase interest rates. But Jerome Powell said that higher interest rates are now more of the norm, and we should not really expect a return to lower interest rates, and that this is more of the normal playing field as to where we are in now, and that these higher interest rates, it's not that they will go higher in the future, because it's very interesting. They didn't raise rates, even though inflation in the United States had definitely gone up last month. But Jerome Powell said they have a good posture now on the market, and with the inflation where it's at, that keeping rates where they are at now for the foreseeable future will keep inflation from rising further and will keep it under control. So really interesting to hear those comments from Jerome Powell yesterday when the Fed decided to keep interest rates at 25 basis points. And the fact now that we need to get used to this higher interest rate environment means that it's a big deal now to be able to look at your mortgage when you're refinancing and to be able to access money at as much of a cheap interest rate as possible, because keeping that cash flow in your pocket rather than the banks is going to be key right now in being able to keep you guys being able to have those extra funds to be able to either improve your home to improve its value or pay down that mortgage quickly so you don't have to pay a mortgage off for the rest of your life. So again, let's talk this example out. I know those watching on Instagram and TikTok don't have the numbers here right in front of them, just above my head here. But essentially, what we're looking at here is there's a current mortgage. The person is paying $611 biweekly right now at 2.19%. They locked this in during COVID. And with that, they want to take out $100,000. This person wants to take out the $100,000 to be able to consolidate some credit card debt, which is at an interest rate at 19 or 20% plus, plus, plus. And you should never, ever carry credit card debt more than a month or two. Really focus on paying off your credit card debt whenever possible. Your $1,000 item can quickly turn into a $1,000 forever item. So $611.43, and they're looking to pay off some credit card debt, put some money aside into some home upgrades, and also looking at taking out some money for an emergency fund, just to keep that money in there for their emergency fund. So if you're joining me on TikTok or Instagram, I'm pointing up here because there's numbers above me on Facebook and LinkedIn and YouTube. So just hang on with me here. And they're looking at taking out $100,000. So instead of taking out a new mortgage right now with their bank, going from $350,000 to $450,000, putting their monthly biweekly payment, at $1,271.51, effectively more than doubling their biweekly payment in comparison to before, because they went from $350,611.43 biweekly to $450,000, just above me here, at 6.29%, $1,271.51 biweekly payment. Now, the strategy I want to employ is option B here, which you see right above my finger here, and that is to be able to blend your existing fixed mortgage with the new funds that you require, and essentially lowering the overall effective interest rate and reducing those biweekly payments to $884.14. Big deal. Big deal. So the new interest rate is only applied to the extra amount you borrow. Therefore, you are able to keep your existing 2.19% locked in. When we do this, however, we can still only guarantee this amount, the rate, and the amount per payment until the end of your term. But we are able to essentially lower the amount of interest rate right down for your refinance. So when you're accessing that equity, you're able to pay off those credit cards or get that money for your home upgrades and that emergency fund replenishment, or whatever your needs are, at a much lower interest rate than just refinancing your entire mortgage altogether. Now, some lenders allow you to add this as a component to your existing mortgage. When I work with them, essentially, we keep both mortgages, and there's a separate payment for each component. And with that, the two payments together add up to the $884.14. Some lenders essentially blend the two payments together for a new biweekly payment altogether at $884.14. And it works like that. Some lenders also track it separately on their annual mortgage statement, and some lenders they combine it all into one mortgage. The important thing is it buys you some time before your mortgage actually matures to hit that higher interest rate. So it allows you to get those funds that you need to access that equity right now as soon as possible before your maturity date, keeping that low interest rate. And then when you're at that maturity date, only at that point are you faced with that higher interest rate. Now, by that point, ideally, you have paid down your mortgage quite considerably because you consolidated all that other debt and you were able to use that extra cash flow to funnel right back to your mortgage. However, if not, then hopefully your income has increased enough to be able to cover that new payment once you do renew, because you will have to hit that renewal point at some point when you have refinanced for a higher amount. All right, so if you have any questions, please let me know. Otherwise, what I wanted to do is just to cover off some other interesting items that have happened this week in the mortgage market. Really interesting to hear. Let's see if there's any other questions here. If you're watching me on LinkedIn or Facebook or YouTube or Twitter, you're going to be able to see the figures here right in front of you. And if you're watching me on TikTok or Instagram, you really can't see the figures the same way. However, you're able to see me talking through the numbers with you. But essentially, what I wanted to talk to you guys about today is when you're refinancing your mortgage, it's important to be able to keep that interest rate that you have locked in for your existing money and not to allow the bank to upsell you into selling you a whole new mortgage. Not only will you have to pay the bank a penalty, but you will also have to pay the bank's new and current interest rate on all the money that you're having. So essentially, what you want to do is keep your existing mortgage locked in. And when you're meeting with the bank or myself, we essentially add the funds you need to your mortgage at current rates, but keep your existing rates locked in, keeping your biweekly or monthly payment as slow as possible, and giving you that extra equity you need to pay off those credit cards or whatever ASAP at that lower interest rate. And again, if you're just joining us, the example we used, just one more time here, is a $350,000 balance mortgage currently locked in at 2.19%. Yes, it is like two separate loans. 350,000, 2.19%. This person has a $611.43 payment biweekly. They need to take out an additional $100,000 to upgrade their home. They want to add a deck, maybe improve their kitchen, pay off some of those credit cards that they have, and replenish their emergency fund. So if the bank's going to sell you on a whole new mortgage at today's rates, which are 6.29%, your new biweekly payment for $450,000 would be $1,271.51 a month. But you don't want the bank, you don't want to let the bank do that to you and upsell you for that new higher mortgage. What you want to do is tell the bank you're keeping your existing portion locked in and you want to blend with the new money. So that $450,000 that you're now borrowing turns into a biweekly payment of $884.14 versus $1,271.51 biweekly. Huge difference. And that blended rate essentially becomes 3.101%. So a pretty good rate overall. So if you're just joining in now, we just covered off how to keep your low rate when you're refinancing for your mortgage. And we just covered all of that. You want to go back and rewind that for that information. For the future, I want to cover off some updates in the mortgage market. Fixed rates have been going up this week again, and this was in response to the Bank of Canada, the Fed in the US keeping rates where they are at. And why would you think the fixed rates have been going up because of that? Well, the bond market, which the fixed rates are largely based off of in Canada, spiked over 20 basis points on the day that the Fed announced that they're keeping rates where they're at, because Jerome Powell in his speech had made the remark that this higher rate environment is now here to stay, that we don't anticipate going back to a lower rate environment anytime soon. In fact, for the foreseeable future and into the future, because what they see as being an inflation manager is the rates being high for a longer period of time. And that's something that he made a remark on yesterday during his speech when he made the comment that they are not raising rates now. Instead, they're keeping rates where they are at for the long term. So if you're looking at getting a mortgage or you're coming up to your renewal, make sure you take these considerations into mind, because when you're looking at either going variable or fixed, and fixed for whatever amount of years, you want to take into account these comments, because the Canadian economy is largely based off the American economy. And if the economy is going that direction, then we're going to follow one way or another. Not exactly sometimes, but a lot of the times we do follow a lot of things. And their inflation did go up last month. If we look at the United States inflation rate, it went from 3% in June to 3.2% in July to 3.7% in August. And because of that, the Fed did raise their rates in July. I think it was the 26th or 24th, but they didn't raise rates this time, citing that inflation going up right now will happen. They're leaving one more spot open down the rest of the year for a future rate hike. But for right now, no rate hike, and they're thinking that rates are going to be high for the indefinite next few years. Sell your property, won't be able to afford it soon anyway. That's a question I have for a lot of landlords right now, because your comment is spot on. There's a lot of landlords right now getting renewal statements. Their mortgaged rental properties are going from 3% to 6%. A 100% increase on the interest rate. Imagine the havoc they're wreaking right now when, John and Jane, they are a teacher and a, retail worker at Walmart. Together, they own a rental property. And all of a sudden, they're faced with a $1,000 increase on their mortgage payment on their rental property. And their rental property already has not been able to cash flow properly, because insurance rates have gone up, and utility rates have gone up. So they're only making a few dollars a month right now, maybe $50 a month. And now they're going from making $50 a month to being in the negative $950 a month. So what should these landlords do? These are landlords calling me, asking me what I should do. So for the renters out there, would you prefer your landlord sell, and that the new people that usually go in are multi-generational family homes from people that are immigrating from other countries? It's 6 of them all buying the house together. They all live together, and it doesn't matter. They just turn that home into a single family home for the family, and it eliminates a rental unit, and you're out. So would you, as a renter, prefer your landlord sell, or get a part-time job, or get their kids to get jobs to contribute to their rental property? Like, what should a landlord do? Or should the landlord split the cost with you as a renter? Maybe a 50-50 agreement. Anyway, I don't know what the right answer is, because in Ontario, you can only increase rates on rental properties by 2.5% in 2023. So it's not very much of an increase that is allowed. So when you're looking at 100% increase on your interest rate at renewal time, that becomes a little bit of a disconnect that the landlord needs to deal with, which I'm seeing a lot of landlords having to deal with right now. So another thing that goes along with your comment here, I don't know how you say your name, Goodly or Godly, but the national average house price, it's come down again this month. In August, down 3% this month to $650,140. Great news for anybody that's looking into getting into the market when the prices are lower. Right now, we've seen the average national house price drop 3% in August, and we did also see a 6% decline in July. So 2 months of significant declines in the Canadian house prices. This is going to put a lot of pressure on buyers wanting to get in. I've even seen a lot of buyers trying to get in right now. Let's see here. Are you after going up. How much is the last 3 years, though? Yes, so you're right. There has been a lot of significant increases in the last 3 years. If someone bought 3 years ago, they are sitting on a heck of a lot of equity. Just saying. If you're looking and getting into the market, is this the right time? That's the question. That's what I'm asking here. If you're looking at getting into the market or buying another property or selling, like, just to keep that in mind, we're down 3% this last month in August, 6% in July. Huge decreases. Waiting for Trudeau to get out. I'm sure a lot of people are. So make sure, if you're just joining in now, follow, like, subscribe to my channel. I come out with a new podcast once a week and talking about different mortgage strategies. So this week I'm talking about how to keep your mortgage rate low. If you're just joining me now, make sure you save this podcast and watch the first 15 minutes when I covered off how to keep your mortgage rate low and payments low when refinancing. So average house price dropped in Canada again. Inflation, though, these are huge numbers. We're back up to 4% now in Canada. In June, we bottomed out at 2.8% inflation, and since June at 2.8%, we've gone up to 3.3% in July and 4% in August. And holy moly, the Bank of Canada kept rates where they are at in September because they said the economy was slowing down. So it's an interesting situation. Inflation's now going back up. House prices are coming back down. And economy's starting to slow down. I'm not sure what's going to happen now into the future, but that is interesting news, because if inflation keeps going up, the government will have to continue to raise interest rates. What else is happening? So the bond yield, it's up to 4.239%. I'm already getting emails here from my lenders today that fixed rates are going up, and to get your files in before midnight, because once midnight comes around, those rates are not available anymore. So all of a sudden, there's a lot of pressure on me to get these files in for my clients that have been sitting on the fence and lock them in. Yes, oil does play a lot into inflation for sure. I know gas prices have been up. I was filling up my car just the other night. I couldn't believe what I paid. I mean, it's just so much more now than it was 2 years ago. So United States inflation, it's up. Canadian inflation, it's up. House prices, they're down. Interbank rate, so it's at 5.49% right now. Interbank rates, what I use to measure variable rates, are a good competitive option. Currently, they are not. Now, are people taking variable rates? Some are. I'm speaking with a few people right now. They are taking variable rates. And it's interesting because they want the flexibility to be able to pay off that mortgage at any time at the lowest possible prepayment penalty available. And that's only through a variable rate mortgage, because a variable guarantees you that the penalty will never be more than 3 months interest charges on your mortgage. Otherwise, when you lock in your mortgage through a fixed rate, you get the advantage of being able to lock in your rate in case rates go up. But if the bank does see you want to cancel your mortgage, then they have the right to charge what's called an interest rate differential, potentially clawing back all the interest that could have or would have been charged for that term of your mortgage, which turns into quite a lot of money sometimes. I've seen fixed rate penalties north of $20,000, which turns into quite a high amount of interest. Now, looking at what else we need to cover today, if you're just joining me now, my name is Joe Bladdock. I'm a mortgage broker in Ontario, Canada, 13 years in the business, helping people get rental properties, first-time buyers, refinancing. Today, we covered off how to refinance your home and keep your low interest rate. We looked at an example at 2.19%, and we looked at blending that rate with a new rate so that person can take a new mortgage and not be upsold to resetting their mortgage interest rate to the current rate on the entire balance, but essentially blending their rate with the new rate and keeping their old rate. If you have any questions, you can always reach out to me directly. My name is Joe Bladdick. You can reach me on social media directly on TikTok, Instagram, LinkedIn. You can reach me on YouTube, Twitter, Facebook as well. And I'd be so happy and excited to be able to handle your mortgage inquiry. I can handle renewals as well. If you're looking at switching your mortgage, there's a lot of opportunity now to have your lender uh, looked at, and we can look at other lenders to see if we can switch your mortgage to a more competitive rate. And a lot of the times, these new lenders, they will actually pay for all the costs, appraisal costs, legal costs, to switch your mortgage to their lending institution. And sometimes you can really save a couple points on your interest rate. And because of that, just by paying the same interest rate, you've paid on your mortgage that much more by the end of the term. All right. So until next time, thanks for watching Canadian Mortgage Weekly. This is Canada's only weekly video mortgage news podcast. And we look forward to seeing you next week on Thursday. Make sure you follow this account to see next week's episode. I'll have to see what that is, but it'll be episode number 159. We're close to celebrating 160 episodes here on Canadian Mortgage Weekly. We'll see you next time.